Good afternoon, everyone. In today's video, we'll talk about the Futures Volatility Box setups for April 28, 2020. Now, depending on the kind of asset class you trade, today was either a really good day for you or a frustrating day. If you trade only the indices, we had breaches across all four of our indice markets, so the S&P, the Nasdaq, the Dow, and the Russell, but all four of these breaches came at the edge of an hour. That's where, using our more conservative rule set, those aren't necessarily trades that have the highest probabilities, and so it's not a place where you may be willing to risk your capital. So that's where those trades were not valid entries for me. The only place where I did have a valid entry was in natural gas, but there, being patient paid off, right? I had an opportunity to enter using our volatility box trade plan and rules. That one trade gave us both our T1 and a T2 for a positive $420, and the total risk on that trade was only $240 over two contracts with 120 per contract. And that was it. That was the trade for today. Now, if you are just an S&P or a Nasdaq trader, and I know a few of you are, that's where you may have been a bit more aggressive. And I know many of you choose to ignore the edge of our volatility box rules, especially those of you that are trading only these handful of markets. And for those of you, you had a really nice day of trading today, especially the Russell traders where that gave you the best reversal. So we'll talk about all four of those trade setups along with the one that triggered via our actual volatility box trade plan rules. And that's the one in natural gas. And those 5 trades will be what we cover in this video. So let's start with a chart of the S&P here, and if we draw our entry line, you check to see whether or not you've breached either side's aggressive volatility box lines. You hadn't, and that was your sign to continue to use the aggressive volatility box. We're then looking for any breaches of the cyan line, and since we're on the most aggressive model, if we get that breach, we'd like to see an edge signal, and once we get that edge signal, we want an entry at the clouds so that we can reduce our risk and actually take targets at the cyan line as a good scalping trade. Now, in the case of the S&P, we had that breach, but that was towards the edge of an hour where our probabilities have reduced. So this is free information. You can sit back, you can watch the trade work out or not work out, right? Because what we've seen a lot of times is price hits this volatility box towards the edge of an hour, we bounce a little here, and then price continues to fall sideways. And that's, again, free information where without needing to put capital at risk, you were able to assess that, hey, price isn't respecting the aggressive volatility box models, and you should switch over. Now, in today's case, you respected them really well, right? This, in fact, gave you a brilliant trade for the rest of the day. You ended up hitting both your targets on multiple charts. This was the S&P. The Dow was even less volatile, where you had better follow through. The Nasdaq also gave you that same follow through, and the Russell was the best chart out of the bunch, in which you really just had a really beautiful reversal from our point of entry, and it fell so far as hitting our actual volatility box clouds. So today, following our rule set kept us out of some of these trades. But now let's see where we did have an opportunity to enter, and that was natural gas. So we'll go through this market the same exact way we approach all our markets. So let's come to our 1-minute chart of natural gas. We'll zoom in, and we'll start by drawing that first hour test. Now, in the case of natural gas, you should be able to see that we did breach our aggressive volatility box, right? So at this point, we're checking to see what happens. If we extrapolate this almost as a line in the sand, who wins from here, the buyers or the sellers? That's to say, do we stop outside of the volatility box clouds first, or do we make the same distance in the other side, which lets you know that the buyers have some sort of control and we're able to see a follow through? Now, the follow through we were looking for was a bare minimum of 17 natural gas ticks, which, if I show you how I got there, you get the cyan line, we go towards the edge of the clouds, and you should be able to notice that our price says 0.017 as this distance. Now, if we see what price did in the opposite direction in terms of follow through, we only went 15 to 16 natural gas ticks before price reversed, right? So you didn't get close enough. You almost, if you have to squint, that's the rule of thumb. If you have to squint, switch on over. You really don't want to be taking trades in the market where you have to try and be on the edge and try and be on thin ice in terms of playing these volatility models. So we switch on over from our aggressive models to something slightly more conservative, which is our doomsday aggressive models. That's the next layer we have. Once we load those up, we check to see whether or not that's respecting price action a bit better. And that is. So now we're on the hunt again for the same breach. Now in this case, we get our breach of the cyan line at this point. Now, are we still on our aggressive model? No, we're on our doomsday aggressive models, right? And so at this point, we're checking to see if we get a breach of the cyan line, which you did get right here. Then did we get an edge signal, which you did get right here. And at that point, any entry at the cyan line or better is valid because we're on the doomsday aggressive models as opposed to the aggressive ones. Our stop is outside of the volatility box, and we're looking for that same fall through on the other side. So that first target was 12 natural gas ticks, which was $120. That second target is where we move our stop to break even, Our target is parked at the other side's gray target line, and that's pretty much it. The trade manages itself on its own. Stop is at break even, target is at the other side's target line, and we wait. Now, we didn't get the short opportunity here in terms of price breaching our cyan line on the opposite side, so that wasn't a trade you were able to play as well, but you did have a brilliant long here that hit all of our volatility box rules, gave you a place to enter at the edge with an edge, was not at the edge of an hour, you had confirmation signals, and you had brilliant follow through. So that's how you can use a volatility box, our trade plan, to go through all 9 futures markets, monitor them really easily using the dashboard that we have, keep track of them, and trade in places where you have an edge at the edge. Alright, hope this video helped. Once again, we only had one trade today in natural gas, but 4 additional breaches using our aggressive volatility box in the S&P, NASDAQ, Dow, and Russell. Alright, take care everyone, good luck trading, and we'll see you in the next update.